Types of economic policies. Economic policies are tools to accomplish some economic goals like price stability, that is, to control inflation, full employment, economic growth, etc. There are two major types of economic policies: monetary policy and fiscal policy. As an individual, we wish to have stable prices of goods and services in the system, that is, low rate of inflation in all areas of economy, like technological products, for example, mobile phone and laptop, consumer goods like vegetables and other food items, durables, TV, refrigerator, furniture, retail goods, etc. But to earn a good profit, businessmen try to sell their products at higher price. Even the value of house property, car, precious metal keeps on increasing. To control such inflation, government takes some measures and fight economic instability. Let's discuss each economic policies one by one. Monetary policy. In this topic, we will discuss about meaning, objectives, monetary policy framework, monetary policy instruments by which government controls money supply, the organizational structure of monetary policy decision. Let's discuss each economic policies one by one. First point, monetary policy. It is a tool used by central bank to regulate money supply in the economy. In case of India, Reserve Bank of India is the central bank. The main objective is to control inflation by using monetary policy instruments. In simple words, when prices of goods and services goes on increasing, central bank in line with central government introduces corrective measures. Monetary policy is intended to influence various macroeconomic variables such as price level, aggregate demand, consumption, investment, employment rate, national income, interest rate, etc. Monetary policy framework. The central bank functions within the framework of monetary policy while executing monetary policy. It consists of three things: objectives of monetary policy, analytics of monetary policy, which focuses on monetary policy transmission mechanism, and operating procedures, which focuses on operating targets and monetary policy instruments. So, in this topic, we will discuss about three things: objectives of monetary policy in detail, analytics of monetary policy, and operating procedures. Let's start with objectives of monetary policy. The primary objectives of monetary policy is to control inflation. It means price stability, rapid economic growth, exchange rate stability, debt management, balance of payment equilibrium, etc. Next, analytics of monetary policy. Analytics of monetary policy. There are four mechanisms through which monetary policy influences general price level and national income. They are the interest rate channel, the exchange rate channel, the quantum channel, and the standard asset price channel, which includes equity and real estate prices. First point, the interest rate channel. During a period of recession, it means when there is economic slowdown in the country, to promote economic growth, RBI reduces interest rate. Reduction in interest rate leads to increase in lendings and production will increase. More production requires more employees, so there will be employment generation and increase in income. So during a period of recession, RBI introduces expansionary policy. Contractionary policy is introduced when there is inflation in the economy. RBI increases the interest rate. Increase in interest rate leads to reduction in lendings and borrowings. Automatically, demand will reduce. If there is less demand in the market, the businessmen will try to sell their products at lower price. So automatically, inflation will get controlled. So during a period of recession, expansionary policy is introduced, and during a period of inflation, when there is inflation in the market, contractionary policy will be introduced. Next, the exchange rate channel. If repo rate in India is higher than USA, then capital flies into India. Therefore, there will be Indian currency appreciation. The exchange rate changes. Therefore, there will be change in export and import price of goods and services. Hence, export becomes costlier and import becomes cheap. Next, the quantum channel. Similar to interest rate channel, the quantum channel operates through availability of credit. If there is availability of credit in the market, producer will produce more. More production requires more employees. Their income will increase, so national income will increase. People tend to demand more goods. As the demand increases, businessmen will try to sell the goods at higher price. On the contrary, if there is non-availability of credit in the market, producer will produce less. There is reduction in employment. National income will reduce. Ultimately, demand will reduce, and businessmen have to reduce the price of goods and services. Next, the standard assets price channel. It is concerned with the prices of equity shares and real estate. If RBI increases interest rate on government securities such as bonds, people will start investing in government securities and there will be fall in demand of equity shares. As demand decreases, price of equity shares also falls. Hence, the main objective of monetary policy is achieved, that is to restrict money supply in the market. All money pulls out by government. So we have covered objectives of monetary policy, analytics of monetary policy. Let's start with operating procedures. Operating procedures and instruments. It involves three aspects. Choosing operating targets. It means short-term targets. For example, inflation, the main objective of monetary policy. Choosing intermediate targets means long-term targets, that is to achieve economic growth. And last, monetary policy instruments. These are tools, tools to achieve objectives. Let's discuss the most important topic, monetary policy instruments. To regulate money supply in the economy, the central bank uses these instruments under direct measures and indirect measures. Direct measures include cash reserve ratio, statutory liquidity ratio. Indirect measures include repo rate, reverse repo rate, margin standing facility, open market offer, base rate and primary lending rate. Let's discuss in detail. The Central Bank of India (RBI), the scheduled commercial banks SBI, ICICI, HDFC, Bank of India. These are the commercial banks. When general public requires money, they go to commercial banks to borrow money. They charge base rate, but when these commercial banks require money, they go to RBI. Therefore, RBI is called as the lender of last resort. RBI is the banker's bank. So, the rate at which RBI lends money is called as repo rate or repurchasing offer. For example, 6%. So, RBI lends money to commercial bank at the rate 6% and commercial bank lends money to general public at the rate 10%. Similarly, the rate at which commercial bank lends money to RBI is called as reverse repo rate. First, repo rate. It is a rate at which RBI lends money to commercial bank. Currently, the repo rate is 6.25%. The time period is 2 days to 14 days. For example, if RBI lends 1 crore rupee to commercial bank at the rate 6.25%, then the interest will be 17,000 rupees per day. Next, reverse repo rate. It is a rate at which commercial bank lends money to RBI. For example, during weekends, commercial bank do not require excess money, so they lend money to RBI. Current reverse repo rate is 3.35%. Next, margin standing facility. Similar to repo rate, RBI lends money to commercial bank for 1 day. The rate of interest is 6.50% currently. This rate is higher than repo rate because commercial bank is urgency in need of money. Next, open market offer by way of purchase or sale of government securities from open market. If there is excess of liquidity in the market, government sells the bonds. Next, primary lending rate. When a person goes to a commercial bank to borrow money, they charge at primary lending rate. Generally, this rate is higher. And base rate is the rate which are provided by commercial bank to their customers at lower rate. So both these terms are same, but difference is that base rate is provided to customers at lower price and primary lending rate is charged to non-customers, outsiders at higher rate. Next, CRR and SLR. What is cash reserve ratio? It is a proportion of net demand and time liability that should maintain by a commercial bank as cash deposit with RBI as a security money. So what is net demand and time liability? Bank has current account, saving bank account, fixed deposits and recurring deposits. So current and saving bank account are net deposits and FD, RD are time liabilities. So proportion of net deposit and time liability that should maintained by commercial bank as cash deposit. So there is no interest on CRR because it is mandated by RBI. If balance is not maintained, then they will be charged penalty. If CRR increases, liquidity decreases, and if government want to increase the liquidity in the market, they reduces the CRR. So commercial bank keeps certain proportion of their net deposit and time liability with RBI as security money. So as CRR ratio increases, the balance available with commercial bank decreases. So they can lend lesser money to the public, hence CRR increases, liquidity decreases. So what is SLR? It is a proportion of NDTL that a commercial bank should maintain with themselves in the forms of cash, gold, or instrument, that is, treasury bill. Similar to CRR, if SLR increases, liquidity decreases, and if SLR decreases, liquidity increases. Let's check these rates on RBI website, that is rbi.org.in. As on February 2023, policy repo rate is 6.25%, marginal standing facility rate 6.50%, base rate 6.50%, CRR 4.5% that is required to be maintained with RBI, SLR 18%, 18% of money, that is 18% of net deposit and time liability that commercial bank need to maintain with themselves only in form of cash, gold, or any instrument, treasury bill. So the question arises, if there is shortage of money in the economy, why can't government print currency notes and remove poverty? So because people will start buying things at any rate and start increasing prices and inflation. The organizational structure for monetary policy decisions. Monetary Policy Framework Agreement. It is an agreement between Monetary Policy Committee of RBI and Government of India. It is an agreement on maximum tolerable inflation rate to achieve price stability. Last topic, Monetary Policy Committee. It consists of 6 members: RBI Governor, who is the chairperson of the committee, RBI Deputy Governor, who is in charge of monetary policy, one official nominated by RBI board, and 3 central government nominees representing Government of India. Let's check who is current monetary policy committee members.